And the indirect taxes were cascading taxes. So as you can imagine, there was no value-added element in it. The idea of simplicity is that the basic products should be at low enough rates. There should be very intuitive bracketing of what item goes into what slab. And they realized that there was about 0.7 lakh crores of compensation cess which need not be collected going forward. And they found that of the total GST collections, about 6% was collected in the 12% slab. So if you discontinued it or were brought down to 5%, and you brought down a large number of 28% items to 18%, you would lose about 1.7, 1.8 lakh crores.
This is obviously a consumption boost because 0.5% of the GDP has been given in the hands of the consumer.
And the fact that it shows 5 and 18, it is not very hard to imagine what goes into 5 and what goes into 18. So I think it's a very clean structure. It has taken us 40 years to get here, but I think good progress.
Hello and welcome to another episode of Open Dialogue. Very recently, the government announced fairly significant changes to the GST or the Goods and Services Tax. What are the implications of these changes? How does that change consumption? What is taxation and how does that impact consumers? And broadly, what are the macroeconomic implications of these shifts? This is the topic for discussion today, and I have joining me Neelkanth Mishra to talk us through these topics. Neelkanth, welcome to the show. Thank you. So to start with, Neelkanth, if you can run us through a little bit of the history of both direct and indirect taxation, and we focus more on indirect in India, and in that context, just cover the recent changes that have happened.
So indirect taxes have been a fairly large part of government taxation. So even today, if you take general government taxes at about 17.5%, 18% of GDP, GST is about 6.5%. I think excise duty, which is collected on alcohol, if you add to that the excise duty, which is collected on petrol products by the center, that would add up to another 1.5%, 2%. So indirect taxes are a very large part of tax collection in India. Till the mid-1980s, the indirect taxes were cascading taxes. So as you can imagine, there was no value-added element in it. The difference is that if I collect 5% tax on the inputs to toothpaste, and then I collect 5% tax on packaged toothpaste, which you and I buy, if the producer of that toothpaste is not able to claim credit for the 5% on inputs, it is a cascading impact. So and so it's very inefficient. It makes manufacturing less efficient, less competitive. And so it was in 1986 when mod VAT was added. So it was a modified value-added tax. VP Singh was the finance minister. Over a period of time, the need was felt. So in 1999, the first NDA government, so Atal Bihari Vajpayee's government, so he constituted a committee. He was advised by 3 ex-RBI governors that we should introduce something called goods and services tax, because there were many inefficiencies on the import side in order to equalize, because see, you were charging excise duty and several other duties on local manufacturers, but you were not charging anything on imports. So there was something called special advanced duty, I think SAD. There was of course the countervailing duty, which was the equivalent of the excise duty. There were sometimes exemptions given on that because of lobbying or whatever. There was no offset available. So while some value-added tax elements had started coming into excise duty, which was on manufacturing, if you were having services as input, you could not take that credit. At the state level, where again the so the state governments had their own tax slabs. So there were things that were, there was a average rate of say 4 to 6%. So some states at 4, some at 5, some at 6. There was a high rate of 12%, 10 to 12%. Some were at 14 also. And then when you were crossing state boundaries, the manufacturing states would charge what was called a CST, a central sales tax, which was another 2%. So it was a very complex structure. So you had, I think, 17, 18 different types of taxes and duties. And therefore, in 99, that committee suggested that we should have a nationwide GST, which would combine the national market. Over a period of time, consensus started building up, but it was still a very hard call to take because there were so many interested parties. Like some states thought they would lose a lot of revenue. So suppose you're a manufacturing state like Gujarat or Maharashtra or Tamil Nadu, you felt that if you moved to a GST, which is a consumption-based tax, you would lose out on revenues. The states also feared that because if a combined GST council was going to be setting rates, because if you were setting your own VAT, value-added tax, that is a sales tax at the state level, you had a lot of fiscal freedom. So you could, if needed, raise some rate from 4 to 6% to get some additional revenue. But they were apprehensive that they would lose that independence, and the GST council would then become too rigid a structure. Globally, this is also a very messy process, especially in large federal governments. This indirect tax structure is actually very, very complicated. The finance commissions also over a period of time. So I think the 10th and 11th, no, it's 11th and 12th finance commissions also recommended that GST should happen. But it was a very hard plug to pull. And I think more than just the administrative decision, I think building consensus among all the states was found to be very difficult. But around 2015, I think the government was advised that this is an important reform, this is an important structural reform. It was very important to make manufacturing more competitive, because what used to happen was that the trucks would take a very long time to travel from one state to the other, because at every state boundary you had to stop because the CST had to be levied. And every state was apprehensive that they were starting to lose VAT and all that. So there was a lot of checking that used to happen. As you can expect, a lot of corruption that used to happen. And 30-40% of the long lead times that existed between the various states in logistics in India was because of some of these levies. The second issue was that companies would optimize based on local markets, not on the basis of national markets. So the GST, the decision was taken, and 2016 the Constitution amendment was passed. In 2017 the GST implementation started. It has, in the first few years, there was a lot of adjustment and settlement. There was a lot of chaos in the first year. It was also the aftermath of demonetization, so it actually created some more uncertainty in supply chains. But over a period of time, I think it has settled beautifully. It has significantly simplified compliance. It has significantly broadened the tax base, and provided much desired simplicity to overall taxation in India. So it's been a very big step forward. But again, journey that started effectively in '86 over a period of time has been progressively simplified. I must say that the 2016 structure, 2017 structure was a bit more complicated than what had been recommended. So I was an advisor to the Revenue Neutral Rate Committee to the GST back in 2016. And the committee that was advising had recommended either one rate or two rates. What the bureaucracy at that time chose to do was, instead of targeting one or two rates, which would have made the whole collection revenue neutral, because the first objective was that if you were collecting X amount from excise, from sales tax and all of that, and service tax, when the combined pool, GST should deliver the same amount of revenue. We had done some calculations, but clearly the GST Council did not find it very compelling. And so they targeted, and therefore they started to do what is known as item-wise revenue neutrality, which is that if the state VAT was, say, 4 to 6%, and central excise was 4 to 6%, you make it 12. If state VAT was 0 and excise was, say, 4 to 6%, you make it 5. If it was 12 and 6, you make it 18, whereas 12 and 12, you make it 28. And then there were the sin rates which you applied compensation says. So they tried to do item-wise revenue neutrality in order to get overall revenue neutrality, which made the taxation actually quite complicated. I think the reforms that have been implemented starting 22nd September go back to the original clean GST rates. In fact, I would say that it's even better than what had been recommended. The idea of simplicity is that the basic products should be at low enough rates. There should be very intuitive bracketing of what item goes into what slab. And the fact that it's just 5 and 18, it is not very hard to imagine what goes into 5 and what goes into 18. And then a few products at sin rates. So I think it's a very clean structure. It has taken us 40 years to get here, but I think it's good progress.
Thanks, Neelkanth. So, couple of things from what you said and will be helpful to get further perspective. First is that historically the way taxation worked was the tax was applied at the time of production. So, when the item left the factory, the tax was applied. GST is at the time of sale. So this is a big shift.
Yes.
And will be helpful subsequently to understand from you why this is a big shift. The second thing you mentioned, which is not, it didn't happen with GST, but happened maybe sometime earlier, which is earlier, let's say if you were making, coffee powder, then there was some taxation applied at the time. Like somebody made coffee, somebody kind of sold coffee beans, there was tax applied at that point. So let's say coffee beans were 100 rupees and tax was 5%. So the coffee beans was bought at 105. Then somebody maybe refined it and crushed it. So, and say their sale price was 110. So another 5% was applied on that 110. Then it went to somebody who packaged it and, put a brand and so on and so forth and sold it, and another 5% was applied. So this taxation was compounded.
Correct.
Whereas in GST, actually, the taxation applied to the first person is subtracted from the taxation of the second person. So tax is on the value added.
So it's called input tax credit. Yeah.
Input tax credit. And so basically what this has done is that there is only taxation one time in the sense it's on the end, like when you add the entire value chain, there is one tax on the value chain. It is paid by different people, but it is one tax on the value chain. And so specialization as an example becomes easier. Like in this case, if let's say if somebody grew the coffee, crushed it and sold it, he would have had much lesser taxation in the earlier regime. Now, actually it is not that different. So it's neutral to split the value chain.
Yes.
And that encourages specialization and so on and so forth. So that was the second point you mentioned. Third, you mentioned about this point about the manufacturing states and the consuming states. So in the earlier schemes, the taxation was, because it was at the time of goods exiting the factory.
Yes.
The tax was applied by the state where the manufacturing happened. Now the tax is applied by at the point where the consumption happens.
Yes.
At a national level, it doesn't really matter much. From a consumer perspective, it doesn't really matter. You are paying probably the same price. But from a state fiscal budget, it is a material shift because revenues go in very different directions. So that also will be kind of great to deep dive. I'll take one step a little bit back, which is just if you can just explain for us what are direct taxes, what are indirect taxes, and what do they do? Like, how does a government think about, or how do economists think about either? And
Okay, so see, direct taxes are taxes that you apply on income. So it is personal income or corporate income, and they are supposed to be progressive, meaning that even if you apply the same rate to everyone, the fact that the person was earning 100 rupees, if it's a 10% rate, would pay 10 rupees. If someone is earning 10 rupees, they'll pay only 1 rupee. So it is naturally progressive. Indirect taxes are also a form of tax, but you're using either manufacturing or consumption as the tax, so they are considered regressive. So if you charge, say, 5% or say 10% on a tube of toothpaste, so suppose the toothpaste costs 10 rupees, a rich person would also will have to pay 1 rupee, and a poor person would also have to pay 1 rupee. So as a percentage of the poor person's consumption or income, it becomes very regressive. So I think it is much easier to levy consumption taxes. So most governments find it easier to tax consumption or say even trade. So customs duty is also a form of indirect tax because you're not directly taxing the income of the person, you're indirectly taxing it. The challenge and the problem is, of course, that it becomes very regressive. So in principles, you want the rich to pay more tax, and there should be some equalization of post-tax income, and therefore the richer countries, the more prosperous countries, and supposedly more efficient countries have a higher share of direct taxes than indirect taxes. Whereas as a pattern, because in any society, the rich tend to also have much bigger control on the government, their ability to manipulate systems and evade taxes. So direct taxes are also harder to collect. So unlike for salaried individuals, if the moment you get into businesses and professionals, the assessment of income becomes very challenging. And this has been a challenge for most countries throughout history. As we've discussed in the past with regards to the US, they did not have any income tax, much of an income tax. I mean, they had shortly during the Civil War, but it was only after around the First World War that the income tax started to get introduced. And for many of the countries, income tax collection only started once the tax deducted at source started happening, that the companies were made responsible, and therefore the salaried individuals like you and me have always paid way more than what other professionals and businesses have had. So this is a common problem of process of collection. So indirect taxes also cause, as you rightly summarized, a lot of inefficiency if you don't bring in the value added element, that you should only pay tax on the value that you're adding. Otherwise, you end up cascading, and the eventual burden of taxation then becomes so high. And remember that in some of these, there is also the element of the Laffer curve. The Laffer curve basically says that if of course, you have zero tax rate, you get no taxes. But if you have a very high tax rate, you again get very low taxes. So there's a curve that you get. The optimal rate at which you maximize taxes could actually be much lower than what you think is a peak tax rate. So compliance. So for example, if anecdotally one noticed that some items, like if someone was doing interiors for their houses, some of the plumbing fittings or light fittings were at 28%. And you would notice that a lot of cash payments were made because it was the interest of the buyer and the seller that you avoid the 28% tax. So the moment it falls to 18%, it starts to make slightly more sense that why evade, it is better because it's a low enough tax, people want to pay it. So if the effective tax rate because of cascading was ending up being too high, the whole supply chain, there was a risk that they would go under the tax radar and you get actually a lot of leakage. So if you reduce the tax burden, make it more efficient, as they say in the principles of taxation, that tax should be collected like bees collect nectar from a flower. It doesn't hurt the flower, and then the bee gets the nutrition. So it's the same concept, but I think cascading taxes and excessive indirect taxes violate that principle.
Understood. So one way of thinking about taxes is that tax is an instrument for income redistribution.
Yes.
You're kind of collecting money from some people, and the government government has no interest in keeping the money. It's finally going to spend it somewhere.
Exactly. Yeah.
So it is taking money from some folks and it is spending, which is going and benefiting some other folks. And hence this direct tax are considered progressive because it's in tax on how much you are earning. So if you are earning more, you pay more taxes. Indirect taxes are flat in the sense that, as you said, like a toothpaste is a toothpaste is a toothpaste.
Correct.
So you pay 1 rupee, I pay 1 rupee, the richest guy also pays 1 rupee, the poorest guy also pays 1 rupee. So there the income redistribution is kind of not
Correct.
really of the right nature, whereas in this it is. And the second point you made around this Laffer curve is essentially it's a question of tax rate versus compliance.
Yes.
And so there is some optimal level where, when you reduce taxes, then compliance goes up and hence you get
Aggregate tax collection.
higher tax collection. Great, Neelkanth. So I think after India launched GST, obviously there was this initial period of, lot of chaos, which you should expect in a large transition of this nature. Also, it was a technology
Yes.
intensive transition. So there was, I think, a year and a half where
Yes.
there was a lot of this thing. But once things settled, this one of the most talked about statistics is the monthly GST collections, right? And those numbers just seem to have galloped.
Yes.
And so, in your mind, this is mostly growth in the economy, or is it also a bit of this Laffer curve kind of playing through, or like what really happened there?
No, I think it's of course there's a growth in the economy. So remember, we are a very high nominal growth, GDP growth economy. So anything which is related to GDP, and then GDP is aggregate income. So tax collection will go up. So what is helpful then is to look at GST collections as a percentage of GDP. So GST collections as a percentage of GDP has sort of drifted up over the past. Now, what is so it has not gone up dramatically, but there you have to adjust for the fact that the effective GST rate, which the R&R committee had pegged at about 15.5%, and then in the first 2-3 years of GST, progressively some rates were brought down on things like restaurants. They found it very hard to enforce value-added taxes because the sourcing was so informal that they couldn't implement it properly. There were too many small restaurants. So they said 5% flat fee, a flat charge with no input tax credit. So many rates were actually brought down. So you remember that R&R committee at 15.5%, and before this reduction, we were at 11.3%. So, so the tax rate had been progressively brought down. Because of this, the fact that the GST collection as a percentage of GDP remained broadly unchanged or actually marginally drifted up, means that the tax base really broadened. Because there were many other innovations that were brought about in GST. The first was that they made the companies responsible for compliance. See, because from the government's perspective, because eventually, see, it's as much as redistribution is an objective, the first objective of the government to collect tax is to just run the government.
Yep.
In that you need to pay the army, you need to build the roads, you need to administer various legal systems, and lots of other things that you need to do. But from a taxation perspective, one of the most important measures is how much money are you spending to collect the taxes that you're collecting. Now, if you start chasing after very small businesses, the cost of that collection may not justify or rather, cost of the collection may be so high that that effort is not justified. So what the GST mechanism did was that made the companies responsible. That if you don't file input tax credit, or if your supplier has not filed the invoices, then you will not get input tax credit on that. And that made sure that the companies, and that was one of the biggest transitions. See, earlier the tax compliance used to be at an entity and period level.
Correct.
That a company, and that too, every state, like, so if you're a national company and you were operating in 15 states, so in each of the states, there would be a sales tax calculation at the end of the month and you had to pay for that month. What GST did was move the granularity to invoices, which meant that a lot of formalization had to happen. A number of small firms had to start getting accounting systems and start filing invoices because their company. So it was in the company's interest to make sure that your suppliers were filing the invoices. Otherwise, you would be denied the input tax credit. So that significantly widened the base. So in state after state, so if I remember right, I think all of Bihar I had this discussion, I think, in 2018-19. All of Bihar, I think, only had about 300 people to administer, only 35 people. It was a very small, surprisingly small number um, to administer all of indirect taxes. And yet, because of GST and because of these changes that happened, the number of filers just expanded dramatically. So in the first 4-5 years of GST collections, the number of filers rose remarkably fast. Still, of course, the 80-20 Pareto principle rule still applies. I mean, the larger firms pay a lot more tax, but the base did widen significantly. And I would say that I think the compliance improved significantly. Otherwise, we would not have seen the tax to GDP ratio being drifting up, despite what is a very significant reduction in the effective tax rate.
Right. So the kind of the operative point you mentioned is that today, if say there is a large company which is buying from an SME, the large company can claim input tax credit only if at the invoice level the small company has paid the GST before kind of selling it to the large company. So there is this tracking that almost in the system that is done at an invoice level of tax paid by this guy minus tax paid by this guy. If this guy has not paid the tax, then this guy will not get the input credit.
Yes.
So the large companies start to hold now, like they will, as an example, not work with the supplier who's not paid their tax.
Correct.
Earlier, we didn't have systems which could do this.
Yes.
So this guy would pay his taxes on a monthly basis, irrespective of invoices and whoever is selling to. This guy just assumes that this guy has paid the tax and he purchases. And so there could have been a lot of kind of avoidance. Now, that is kind of out of the picture.
Yes.
So this is obviously one big innovation that has made compliance much stronger. And hence also everybody has to invest in the tech systems and, which has its own benefits, I presume, around efficiency of how.
And what it did, so a lot of the growth that we are seeing in SME lending is now underwritten on the back of GST invoices. So so the fact that so many of the small firms now have accounting software and they are filing their invoices, and those invoices are in a way being certified by their customers. And so that is seen as a proof of revenue. And against that proof of revenue, banks like ours can actually lend. And so the expansion in MSME credit, which is happening at 15-20% a year at the system level, to a large extent is underwritten on the back of these invoice data that become available.
Yep, absolutely. Great. So Neelkanth, I'll take you back to one of the points you mentioned, which is this, credit taxation at the point of manufacturing versus at the point of sale. So just help us kind of talk us through a little bit of what this change implies and what does that do?
See, if your objective is to levy an indirect tax, so suppose you make toothpaste. Now, so there used to be this bonded warehouse. In fact, I don't know if you've been to some of these factories, but so there was a earmarked section which is called the bonded warehouse, and when the auditor came, it would say that, okay, how much inventory is here and has tax been paid on that? Because that was effectively within the factory, you had to earmark that portion. And so if they found that there was more inventory there than what you had paid tax for, so there was a problem. I think compliance was actually unnecessarily complicated. When you moved from state to state, the warehousing, which state it was, in which state it was, can you have national warehouses, how much inventory you're holding. If it takes 3 months to sell from, say, start to end, the tax, actually effectively, because you collected at the manufacturing level, it has to be, that gets stuck. Instead, if you are levying it at consumption, at the point of sale, it is actually much cleaner. Suppose you make something and it doesn't sell, then how do you claim refund? How do you get the stock charge? So it is much more efficient in a model like GST. to levy it at every point of sale. So it is not that if say in a car, if say 18% now is the new rate for small cars. So it's that when you buy or I buy a small car, it is I pay 18%. But the dealer has already paid 18% on the price minus his commission, and and therefore it's not that all the taxes are collected by the government at this point. So it is like, you say 10% is his commission, so 90, but it is just a much cleaner way. Once the consumption has happened, then you actually levy it. Otherwise, if you start doing it at a manufacturing level, it becomes grossly inefficient. And there are also issues that if something doesn't sell, then how do you get that credit for that and all that? It's actually quite complicated.
Right. But from a state finances perspective, what changes did this make?
So, see, the apprehension that many of the states had was that because they were, manufacturing more than they consumed, and they were getting an extra 2%. See, because the states only got VAT. Excise duty on manufacturing was a central tax. So they didn't have much to gain from it. But if they had, because they were, whenever it crossed the state boundary, they were levying an extra 2%. So their fear was that they would lose out on revenues. So but the whole ecosystem was, or actually the starting environment was so complicated, meaning that you just see the complexity of the taxation, meaning there were some states that, when they purchased grains, they would levy some tax. There was, some states, or actually at the central level, there was a lot of subvention that happened on certain types of service tax. So our view, or at least when I was part of that committee, was that I think the apprehensions were misplaced, meaning that earlier the states had no share of service tax. Now with GST, because it was half and half as GST and CGST, state GST and central GST, and now the states would get a direct share of services tax also. So earlier, whatever service tax benefit they got was through devolution, that the center collected 100 rupees, it would devolve. Here now, and some of the heaviest manufacturing states were also the richer states. So a lot of services consumption happened in those states, and therefore the assumption, which I think was correct, we were making, was that they would end up being beneficiaries because they would have more SGST collection on the services that were consumed in that state. But it is understandable that when you are sitting on the bargaining table and that the committee has to get consensus, so you put your strongest foot forward. The solution that was found was an interim one, that the center promised every state that you would get 14% compounded returns. So if say your total tax collection in the taxes subsumed under GST was 100 in FY17, that you would get 114 the next year and then 129 the next year, stuff like that. And and if you fell short, so suppose your total take that year was not 114 but 113, then the center would pay an extra rupee too, so that you are guaranteed, and this was guaranteed for 5 years. This was an excessively generous concession. So by the 4th and 5th year, as you know, in any compounding series, it is towards the end that things go really awry. The demand, or at least the revenue threshold which had to be met, was so high that the center had ended up paying a lot more compensation than the compensation cess it was collecting. So what was done, just to give the context, the constitution amendment on GST, it enabled the collection of compensation cess. To give you a sense of scale, of the budgeted 22 trillion odd rupees this year, 22.1 I think, about 1.7 trillion, 1.7 lakh crores was the compensation cess, and 20.4 trillion was the overall, the rest of the GST collection. Out of this 1.7 trillion, so it was so about 60,000 crores. 0.6 trillion was tobacco, cigarettes and pan masala and all of that. About 0.4 trillion was coal, and there was some on sugary drinks, some on mid and large luxury cars, and so on and so forth. So this cess was identified as it will be a pool that will be sort of gathered at the center, and as needed the cess would be distributed to states which needed the compensation. In the fourth and the fifth year, the demand for compensation or the need for compensation was way higher than the cess that was being collected. So the center had to borrow from the future, effectively issue what I would call off-balance sheet debt, so that the states could be compensated on this. But I must say that by and large, of course, every state has seen divergence, and frankly, given how complicated the earlier tax structure was, it's very hard to do a like-to-like comparison.
Right.
But I don't think at a gross level, the states have really lost out on that much revenue, or that some states have gained more. I haven't seen conclusive evidence on that.
Understood. Great. So, Neelkanth, we'll shift tracks a little bit and come to the latest changes and talk a little bit about what that does. So, first, just helpful to understand from your perspective what prompted these changes and what is the impact that the government is expecting from making these changes.
So before that, just to complete the last point, one of the reasons why it's also inappropriate to measure the impact on specific states was that the enforcement of GST, below a certain size, is with the state governments. So as you can imagine, there was a lot of administrative division of work that needed to happen. Because the center had a very big department for indirect taxes. It collected excise duty and service tax. The states had a very big department to collect indirect taxes, a whole bunch of taxes including value added tax. Now there's only one GST. So how do you sort of divide the responsibility? And anyway, there was some formula used for above this threshold, below this threshold, this type of work and all that. It is understood that because there was guaranteed compensation, some of the states were actually quite lax in the first few years. And in fact, the reason why effective GST rates fell so sharply, I think 15.5%, which was the R&R committee recommendation, but effective rates are I think 12.5%, 13% when GST was actually implemented. And very quickly it fell to 11.3%. It was primarily because the states were very happy cutting rates because they were guaranteed the revenue. And the enforcement also. It is only in the last 2 years that the states have really started to work hard because now the revenue is not guaranteed. So now they have to sort of eat what you kill effectively. In that process, of course, some of them are going overboard and creating new problems. But so this is something that also is important when we think about the first whether revenue neutrality was achieved at a state level or not. Answer to your question on why it was necessary, why was it done now? It was because the compensation cess was ending. So constitutionally, it could not have been levied beyond 31st of March 2026. Because it was to have ended 5 years into GST, but then COVID had hit, and so a 2-year extension was given. And then another 2-year extension was given because the excess loans taken in the last 2 years of compensation. So what the center had done was, suppose it collected 100 rupees of compensation cess, but it had to pay 150 rupees of compensation. So that 50 rupees was borrowed. So it was accepted by the GST Council that the center will keep collecting the compensation cess and retire this debt. So pay interest on that debt and retire that debt. So FY 25 and 26 were periods where compensation cess was being collected, but none of it was being given to the states because the earlier taken debt had to be retired. But after this, because that also would have ended this year, there was no justification for collection of compensation cess. Now the question comes, what happens to the compensation cess? And so then a group of ministers was constituted. Of course, people like us, most advisors have been suggesting that we have an unnecessarily complicated GST structure. I think 28% is an excessively high indirect tax rate because it causes a lot of variation or a lot of evasion. So what the group of ministers, which is a group of finance ministers of various states, had suggested was do away with the 12% slab. So then you would have a 5, 18 and a 28. But I think what the government did when it was evaluating what the central government, what would be the best solution, and they realized that there was about 1.7 lakh crores of compensation cess which need not be collected going forward. So that effectively was one pool of funds which could be utilized, and they found that of the total GST collections, about 6% was collected in the 12% slab. So if you discontinued it, almost, so 99% of the things in that 12% slab were discontinued or were brought down to 5%. And you brought down a large number of 28% items to 18%. You would lose about 1.7, 1.8 lakh crores. So that then the two numbers fit. I think I'm trying to imagine what the thinking that may have happened there. And when they found it, oh, so this is great. So give you a sense of the math. About 14% of the total GST collection was at the 28% slab, and about 6% was at the 12% slab. Now, if you move all of 28 to 18, you lose 10% out of 28, right? So 10 by 28 into 14, which is 5%. So 5% of GST is lost. If you move everything from 12 to 5, the same formula, it will be 7 by 12 because you're losing 7%, 12 goes to 5. 7 by 12 into 6, which is 3.5. Now 8.5% of GST lost, which is into 20.4, so which is about 1.7 lakh crores. So that and compensation cess, and anyway they didn't know, I mean there was this compensation cess which had to be handled. So then it was very easy to cancel the 28% slab. In the process, it's not just the cut in rates, it is also significant simplification. So there are several things that have been simplified. Very importantly, inverted duty structures have been done away with. So in the example that you were also giving, suppose you are levying 5% at every step, then it is very easy to see where the value add is and all that. But suppose, I mean, it's not just that, every manufacturing input has or manufacturing process has only one input. So they can be, it is possible that your end product is taxed at 5%, but several of your inputs are taxed at 18%. So it is quite possible that you have an inverted duty structure, that your liability is 5%, but you already paid 18% on a large part of your inputs, and therefore a lot of input tax credit is accumulating. So the government has to give you refund. Now, I think whenever you ask government for refund, obviously there are different types of challenges because the government, to issue a check, needs to go through so many checks and balances that process get delayed, money gets stuck, and it makes the whole process very inefficient. So in this round of revisions, a number of inverted duty structure problems have also been addressed. That now at least the attempt has been that the input should be at lower rates than the final output. Another thing that has happened, and which is again remarkable, is that the rate setting process reflects the changing nature of our economy. The fact that even small cars were earlier taxed at 28% or 29%. Recently, I read this book, Impossible to Possible by R.C. Bhargav. Mr. Bhargav was involved with Maruti from day one. So the fact that cars were considered a luxury item, there were so many problems that got created out of that. So the government taxed it at the highest possible slabs, and whenever it came to certain concessions, how can we give it for cars? The fact that small cars are now taxed at a standard rate is the government acknowledging that cars are no longer a luxury, which I think is a very important step forward in the government's own thinking, acknowledging that at a $3,000 per capita economy, cars are no longer a luxury. Or the fact that so many items which were branded or branded items which are taxed at 18% have been brought down to 5%. That was not necessary. See, the discontinuation of 12% slab and a 28% slab did not necessitate reduction of rates from 18 to 5. Because frankly, when these discussions were happening and people were asking, will that happen? I said, where's the fiscal space? So most likely they won't do it. But quite remarkably and very rightly, they actually brought down those rates. So this again acknowledges that consumption of branded staples is not a luxury. That as incomes grow, people will want branded goods, and therefore the reduction of rates to 5% if it is a staples item. What is also remarkable is that a number of processed food items have been brought down to 0 or 5. There are many experts of the agricultural value chain who think that in the next 3 to 5 years, there will be accelerated formalization of the food processing value chain. Because earlier, suppose you are making paneer. Now, if you are paying a high tax as a formal paneer manufacturer, there is only so much expansion you can do. Because you are effectively competing with a local halwai,
right,
who is not paying any tax, doesn't have to pay any tax, and therefore has a price advantage. And things that people consume on a daily basis, even 5% is actually 12% also is a meaningful disadvantage. So the fact that all of these rates have been brought down to 5 or 0 is I think very conducive to the. So as this formalization happens, it is not just about large companies benefiting or the process getting mechanized. It is about efficiency gains. It is about the spread of cold chains. It is about reducing of wastage. It is about provision of quality. So there is a lot of productivity gains that can actually come from some of these simplifications. So over and above the reduction of rates, there is also a reduction of inverted duty structures. It is an acceptance that India is no longer a poor country, but a lower middle income and growing to be a rich country. And therefore, certain products should be seen as necessities and not as luxuries. And of course, in some of these value chains like food processing, to actually push it towards more formal manufacturing.
Understood. So great. So basically, it's a combination of simplifying these structures as well as actually a very almost explicit acknowledgement of the shifts that have happened in the economy. And in addition to making some of these things cheaper and so on, it will bring a different level of efficiency because, as an example, the inverted duty structure kind of goes away. Food processing, formalized food processing gets an impetus. So those things could change many other things, which have second, third order,
Yes.
Significantly positive impacts as well.
Exactly. And just to add one point which I forgot to mention earlier, the fact that now the tax structures are a lot more intuitive is also good for compliance. So you would have seen all the drama that was happening around chocolate croissants, chocolate popcorn, caramelized popcorn, right?
Yeah,
so
salted and caramelized.
yeah. So whether it should be taxed at 40 or whatever, or there were circular papad versus square papad. So these are the elegance of this structure was shown that when the Prime Minister announced this on 15th of August, and of course as market observers we had to comment very, very quickly, and at that time it was not clear as to what is going where. So the newspapers were saying that 90% of items will move from 28 to 18 and 99% from 12 to 5, but which 90%? So as we started doing this analysis, we said, okay, so 28%, okay, we have two-wheelers, most likely they'll go to 18. What about small cars? So then the only question is, or commercial vehicles, will they be at 18 or will they be at 40?
5.
Yeah, or 5. Yeah, so it's very clear that it can't be at 40.
Correct.
So this is the intuitiveness of tax structures, which reduces disputes at the ground level. So it is not just about our ability to say nahi to idhar hi hoga. That it is about when the GST inspector goes to an audit. Anyway, they will arm twist and extract something for themselves. Many of them do, but the number of items on which disputes can arise now shrinks dramatically. So this is also a much more intuitive tax slab.
Absolutely. So Neelkanth, let's kind of move on to what does this do to the economy? And economy in two parts. One is what happens to consumption and consumption power, and second is what happens to the balance sheet of the country from the fiscal perspective.
So the consumption part I'll break into two parts. The first is, does this in any way indicate whether the government is now prioritizing consumption over investment? Because one of the most obvious policies of this government has been that it has prioritized long-term investments and supply side improvements instead of encouraging demand. So is this a change of stance? And the second part of the question is, what does this 0.5% of GDP of potential tax cuts do to the economic momentum? And then we'll get to the debt to GDP and stock side. So I don't think this is a change of stance. This is, as we discussed, and this was necessitated by the end of compensation cess. They had to make some changes. And in the process of making these changes, they have significantly simplified the tax structure. And in the process, if a consumption boost happens, that's a desirable outcome. I don't think the government is against consumption, but it is not that they are now going to work on more schemes to boost consumption and deprioritize infrastructure development. So I would not be reading that from this. At the same time, given that there is a 0.5% of GDP worth of sort of tax cut that has happened for through GST, what it does is it magnifies the impact of the monetary easing that had happened. So in many ways, the reversal of monetary tightness that we saw between FY24 and 25, where credit growth went from 16.3% year on year in March 24 to 9.8% year on year in May 25, and even the fortnight ending August 22 was still 9.9%. So that significant decline in credit growth has been a big drag on the economy. The RBI has eased monetary policy over the last 6 months significantly, but it is like pressing on the accelerator without engaging the gear, because monetary policy by itself cannot reverse economic momentum. Because what has been happening is that when some of the large banks were told that your loan deposit ratio is too high, and they started, like the largest private bank went from 14% credit growth to 3% credit growth. So that itself is 2.5% impact on growth. So that itself created a downward downward momentum. And as the deceleration started, all financial firms found that the income growth they had assumed was no longer true, and they started finding stressed borrowers, and they also then became cautious and started pulling back. This was exacerbated by the monetary tightening that happened in the October-December quarter, where the RBI was forced to sell dollars, but at the same time they did not simultaneously buy bonds and re-inject the liquidity. Now, over the past 6 months, some of those have been reversed. But the problem is, when the momentum is downward, as we've discussed in prior episodes of Open Dialogue, it is very hard to for just monetary easing to reverse it, because the driving factor, or the most important driver is the risk appetite for the borrower and the lender. Now, what GST cuts do is that there was a lull. So from the time that the Prime Minister announced 15th August to say about 22nd September, some of the buyers held back because they expected rates to fall. in the first week, so it's been about a week since the GST cuts have been effective, there's been a very strong rebound. So once the economic momentum starts to move up, then the monetary easing starts to become a lot more potent. So I think that courtesy this, there are still some uncertainties. Remember that if say a car that was selling at 11 lakhs now sells at 10 lakhs, so the 1 lakh rupees saved. Now, will the buyer save that money, or will they spend it on something else? The second part is, if you bring down prices by 8-9% because of the supply demand, or rather the demand curve, will demand for the cars go up? At this stage, it's too early to decide on which way both these decisions are going. But as a forecaster, I think there is a reasonable probability that this is going to suffice in terms of giving the necessary upward momentum, so that what was a vicious cycle becomes a virtuous cycle because of the monetary easing that has happened. So it should help economic momentum and help make monetary policy much more effective. The question of what happens, so why haven't bond yields gone up? Because in the first a couple of days after this announcement, bond yields didn't move, but then suddenly there was a fear that, oh, there's a lot of revenue loss, and 10-year bond yields had actually started to go up. But then we clarified that, look, the GST compensation cess collection of 1.7 lakh crores in the last 2 years was effectively not being spent. So if you adjust for the excess compensation cess paid in 21-22, and so effectively the fiscal deficit in those years was way higher than what was reported. And similarly, the fiscal deficit in FY 25-26, because in both these years, this 1.7 lakh, 1.6 lakh crores last year, 1.7 lakh crores this year, was being collected but not being spent. So effectively the contraction, because it was all off balance sheet, was way stronger than what was visible in the headline deficit numbers. So which is why this 1.7 lakh crores, or at least the 0.5% of GDP of stimulus is unlikely, or is not driven any increase in borrowing. So now that the government has announced second half borrowing calendar as well, it's very clear that the government agrees with the assessment we had, and this will not lead to excess borrowing, because extra borrowing, because the compensation cess will compensate for that. What I also think will happen over the next couple of years is, because of the impact of the Laffer curve, because of the impact of better formalization, we should see the tax to GDP in GST also starting to improve. So, but that's a medium term impact. It's not immediately visible.
Right. So basically what you're saying, Neelkanth, is that this is obviously a consumption boost, because 0.5% of the GDP has been given in the hands of the consumer. So everybody, you and I, everybody in the country will now have, higher ability to spend.
Yes.
Whether we save it, whether we spend it is a different story, but we have the higher ability. So government has put money in our pockets indirectly.
Yes.
So that has happened, which is a revenue loss for the government. But in your mind, that is not going to, neither is it impacting the spending plans of the government, nor is it impacting the fiscal deficit of the government. So mathematically, if I'm the government, I'm collecting money from someone, I'm spending it on building something, and whatever is the gap between the two, I'm borrowing from somewhere. So if this falls, either I have to cut this or I have to borrow more. But you are saying that actually here some
so that magic
is the compensation
is a compensation cess.
And so just to kind of clarify that we have a magical situation wherein we are collecting less from this guy, we are spending what we are spending, but we are not borrowing more. And the reason for that is the compensation cess, which is in the last 2 years, the government actually gave more to the states that they collected. And that was in some kind of off-balance sheet item. So for the next 2 years, they collected cess, which they did not spend. They were just paying back the debt that they had. Now they don't need to pay back the debt because that debt is gone. So this this magical item is what is helping do this
Yes.
balancing of this equation.
Yes.
Which is very kind of insightful and little counterintuitive as well. But so just coming back, it's a big consumption boost because 0.5% of GDP we are giving here. At the same time, the deficit doesn't go up and also the spends continue. And in your mind, over a medium period, let's say 2 years, whatever, 1, 2, 3 years, either Laffer curve will play even more because now you rationalize taxes even more, so more compliance should happen. And so actually the revenues may go up for the government, which means that either they can spend more or they borrow less. And also, by the way, if kind of this results in more higher growth, then higher growth itself results in more
Yes.
revenues for the government, and which means that they can then spend
Absolutely.
more. And so sounds like a Goldilocks situation
Yes.
for the government and the country. Great to understand. Now, my next question, Neelkanth, is what does all this do to inflation, and subsequently, hence, interest rates and the like?
So the immediate impact on inflation is, of course, that there is a drop.
Right.
There are various estimates, anywhere between 50 to 60 basis points of drop in headline inflation. How quickly that shows up, time will tell. But I don't think by itself this warrants any change in the monetary policy. In fact, while there will be people who will say that, what headline inflation has come down and we need more monetary stimulus. Remember that this is actually a fiscal stimulus.
Yep.
And so when a fiscal stimulus hits and growth rates start to go up, they also tend to push inflation up. And so if monetary policy is forward looking, and it should be, then this should actually delay any further rate cuts. And if the government stays fiscally disciplined and we find that inflation next year is also surprising on the downside, which at this stage I think is unlikely, but we have to wait and see. And therefore, though at a headline level this will mean lower inflation, it is what I would call a step cut in inflation. See, monetary policy needs to respond to permanent increases in inflation or decreases in inflation. If it is a step jump or a step cut, I don't think it warrants any investment. The challenge for monetary policy or for markets, and this is true universally across countries, is that most markets find it very hard to separate cyclical, seasonal and structural trends. So, is inflation coming down month on month because of seasonal factors? Because suddenly a lot of supply of some crop has come in and inflation has come off? Or has seasonality been disturbed? Like rainfall, started earlier this year, ended, or maybe hopefully will end earlier this year. It doesn't look like it, but suppose it does. Is it a cyclical trend in the sense that have we seen monetary easing or monetary tightening, or is it a structural trend that because of demographic shifts, because of the government structurally bringing down fiscal deficits and debt to GDP, is inflation now going to settle at in the 3.5 handle, or will it settle in the 4.5 handle? So when inflation is moving around, it will always be due to a combination of all three factors. And the temptation and what you will find in markets is that they tend to attribute almost everything to structural trends. And they will say, oh, you know what, inflation is now permanently going to be 2%, and I think RBI rates are too high, or MPC rates are too high, which I think is inappropriate. I think we have to give it time, given that a lot of monetary easing has been done. Very little of this has reflected in credit growth yet. There's been some transmission into deposits and lending rates, but not fully yet. And more importantly, I think credit growth hasn't really revived so far. And therefore, it makes sense to wait to see how this fiscal stimulus plays out before further monetary action is taken.
Right. So the impact on inflation is definitely to cool it down, at least in the short term.
Yes.
If that results in demand getting stimulated, then maybe we'll see like inflation going down and coming back up, because prices will go up
Yes.
in response, and hence kind of on the monetary side, it's a little bit of wait and watch to see how all of this plays out. So related to this, Neelkanth, one question, which is, uh, see, the consumer was paying a price for whatever they were purchasing. Let's say, since you spoke about toothpaste, so toothpaste. So they were paying, let's say, 100 rupees or 110 rupees. Now GST is cut, or let's say they were paying 112. Hypothetical example, 112% GST, it went to 5, so 112 became 100 and should become 105.
Yes.
But the consumer was spending 112 earlier. If I were the company on the other side, I would say that the consumer can afford 112. And so I would have a tendency to say, let me make my 100.
Yeah, that will happen.
Right. So in your experience, where does this equation settle? And what happens if it settles one way or the other?
See, that is where you have to assess whether there is adequate market competition or not.
Right.
So even at the time of the GST implementation, there was acute price monitoring. So our company is passing through the reductions, and there are similar observations coming in from the government this time as well, that if we are cutting GST rates, you have to pass on. You cannot hold on to margins. But frankly, I think it's going to be very hard to control the last 2, 3, 4%. The temptation for some of the companies, that you're right, there was X demand, and there are some things which are absolutely inflexible, meaning cement consumption is not going to go up because prices are down 10%. Because whoever has to repair their house or build a new building, that will be dependent on where real estate, the demand supply is. So the temptation for a cement company to say, let me hold back the prices, there you have to rely on market forces. So for FMCG products, for sure, I think the mistake they made when in 2022-23, when the economy was coming back in a strong way, and at that time supply chains had not fully come back, and therefore it was not a demand problem but a supply problem, or supply was the differentiating factor. So the larger companies were able to get more raw material, get more packaging material, and therefore better able to supply, and the smaller firms were getting shut out. Some of these firms then tried to max out their margins. So some of the lowest end of detergents, I'll not name the brand, it would be inappropriate, but prices went from like 45 rupees a kilo to 73 rupees a kilo, like a 60% increase in, I think, 3 years or 4 years. I mean, if you raise prices like that, when your raw material prices gone up a bit, but basically you're maxing out margins. So in the last 2 years, that 73 is still 73. So they realized that they were starting to lose market share, because once the informal or the smaller manufacturers came back, they started hitting them on prices. So if it is an adequately competitive market, I think it is reasonable to expect that prices will be cut. Another way of looking at it is that of the 1.8 lakh crores, 1.7 lakh crores that of the loss in revenue, and it's between 1.5 to 1.8, frankly, there will be a lot of input tax credit also that will get cut. So, the impact may be not 1.8, maybe 1.5. So about 1 lakh crores is just two-wheelers, personal vehicles, which is cars, commercial vehicles, and cement. 90,000 to 1 lakh crores. And in almost all of those, the price cuts are visible.
Sorry?
Price cuts are visible.
And they are extremely competitive.
Yeah. So they are brutally competitive. And in fact, what I wanted to say was that in things like two-wheelers and cars, because when they found that people were holding back on their purchases, they actually went ahead and offered more discount.
Correct. So they had a GST discount and they had a other discount.
Other discount as well. So a reasonable part has been passed on. On things like sugary drinks, again, you know that we're in the middle of a price war. One big competitor has entered, and so the two big global majors are now scampering to compete on pricing. There may be, like well-penetrated markets, like again coming to toothpaste, where I mean it's very unlikely that people are going to start brushing twice a day because you've cut prices by 5 rupees. The temptation will be to retain some of that, but the other side would be, and if you have enough confidence in your brand, that if say your competitor cuts by 3 rupees and you don't cut by anything at all, uh, if market share starts shifting, so you'll be forced to. So I think the government will try to monitor and try to control these things, but my sense market forces will suffice.
Right. So final one, you can this kind of, if we take a longish view, in I think 2019 there was a corporate tax cut,
Correct.
which was material, actually very major.
Yeah.
In the budget this year, there was the personal tax cut, which was at a very kind of small percentage of people.
Yeah.
But for those percentage of people,
That was a meaningful
it was
cut.
meaningful. And now we have the GST, which basically is for basically all of India, right? Like everybody gets impacted. So the government has done 3 taxation related changes. So again, there is some compounding effect of all of this as well. And for corporations in particular, kind of the previous one and this some of this will
Yes.
go into corporate profits. So it's a kind of a little bit of a bonanza. So how does this play out in the expectations of the corporate tax rate cut, which was that there'll be investment, etc., didn't actually play out fully. Does that change going forward? What is your view on this?
So are you saying that will corporate start investing more because of this? Okay, so between FY19 and FY24, the operating cash flows of the BSE 200, so it's easier to track for the large listed companies, grew, I think, at a compounded rate of about 17% or so, 17-18%. So about 10% of that incremental, I'm not saying 10% of the 17. Basically, if you calculate from FY19 to FY24, whatever is the increase, about 10% of that increase was because of taxes. So a lot of the increase has happened because of better profitability.
Growing,
and growth and profitability. So reduction in corporate taxes has actually, of course, helped. If you view it as about, say, 4.2, 4.3% of GDP, I think there is at least 30-40 basis points of benefit that has accrued to corporations. Given that investment to GDP is about 31%, it is not like that substantial. But in terms of incremental investment, in terms of making India competitive to attract foreign investment, etc., I think it has a meaningful impact. But it is not enough by itself to boost this. The personal income tax collection of, or at least the cut for the 70-80 lakh people who pay more than between 12 to 50 lakh of, report between 12 to 50 lakh of income and their tax rates have fallen. That I will reiterate what I think we have discussed in the past, that it is equivalent to collecting more tax from a lot of people and giving a break to some people. At a net economic level, there is no boost to income. There is no stimulus. So this is the. I'm surprised that so many people, even in policy making, actually believe that there is a consumption stimulus, because the government is missing its personal tax collection targets significantly. But for what it's worth, in the budget, they had budgeted a 14% increase after the tax cuts. So the fact that they were expecting personal tax to GDP to go up means that there was no consumption stimulus in the budget. This one is clearly a stimulus, but as I said earlier, it is not to be seen as an attempt to boost consumption. It is necessitated. It's a much bigger reform. and in the process a consumption stimulus happens. But I do think that as this kind of will engages the gear, you were already stepping on the accelerator, there was a high RPM in the engine, and now this sort of engages the gear and the car lurches forward. That I think will do a lot to bring investment back. Basically, once the economic momentums become visible to all, so it's just been a week since the GST cuts, and at this stage I think people are still calibrating how much of this surge in the last week is just a pent-up demand getting exhausted and how much of it will be lasting. If say by the end of Diwali or Chhath or whatever, in the middle of November and November, if you find that the momentum is still robust, then I think the sentiment starts to turn. Remember that there is also this overhang of global uncertainty. I don't think it matters that much. It matters for a few segments, and we should address some of these issues at a policy level. But at a macroeconomic level, I don't think it is that substantial. But from a sentiment perspective, it does have an impact. I mean, when I talk to corporations or investors, it is remarkable how everyone is obsessed with what's happening to the duties, what happened to the duties. So removal of that clearly will be a sentiment booster as well. So if by end of November we see evidence that the fiscal move is supporting the monetary easing and it is latching on, and the uncertainty or that 50%, that punitive extra 25% goals, that's the least, that's perhaps the only necessary thing that needs to happen on the US-India trade deal. I think the likelihood that sentiment improves dramatically by the end of this year is very high.
Fantastic. Neelkanth, thanks a lot for running us through that very elaborate conversation. We started with a little bit of history of taxation, and we spoke about how at one point in time we used to have not value-added tax, but tax on every product, which compounded through the value chain. We then moved to value-added tax, which was still at the point of manufacturing and not point of sale. And from there we come to GST, which is at the point of sale. Secondly, it is linked through the value chain in a technology manner at an invoice level, which reduces complexity, because earlier we had different structures by different states, and you had all this CST, OCTRA, all of these things which were making logistics very complicated. GST brought one nation, one tax, made logistics simpler. Companies could optimize for the scale of India versus optimizing just for specific states. And so kind of many self-imposed constraints just vanished by the introduction of this tax. After the introduction of GST, we saw, as you said, the effective rate of taxation actually fell, but we still saw that the tax collection outpaced GDP growth, which meant actually that, the tax base grew materially. And so the Laffer curve trend, much talked about Laffer curve, came into action, and it resulted in much better compliance, both because of the simpler structures, maybe lower rates, but also because of this technology-led, implementation, enforcement implementation of this, where the focus was on the large company. And so the large company had to ensure that its suppliers paid taxes, and subsequently the supplier had to ensure that their supplier paid taxes, and so on and so forth. So that played out well. Having said that, this structure was still complicated because there were 4 rates. There was all this, popcorn type of confusion. And we had this milestone of the compensation cess kind of disappearing. And so, driven by all of these reasons, the government has reconfigured GST. This reconfiguration has created some magic because for the consumer, the taxes have come down, and that is about 0.5% of GDP. At the same time, there is no visible impact. The government is saying that there is no impact on spends, nor are they borrowing more. And this equation, as you explained very nicely, it is balanced by this compensation cess kind of disappearing. So this is not magic. This is actually kind of very much rooted in mathematics. But the outcome is quite magical, which is great that we are able to provide a consumption boost without being fiscally without compromising on proper spends, and at the same time not being fiscally profligate. So that has kind of worked out well. In addition to being a consumption boost, this also simplifies the tax structure further. It takes out many of the inefficiencies, and we could see another Laffer curve play out. And at the same time, because of the consumption boost, the GDP could grow faster, which could again increase the collections of GST. So in a medium term, we actually the GST collections may surprise on the upside.
Yes.
Given these things, and the 0.5% of GDP may not actually be 0.5% of GDP. On moving on to inflationary interest rates, this is clearly it'll cut inflation in the near term. What happens in the long term needs to be seen, because demand comes back, prices could go up, and so kind of on the monetary side, in your view, it's a wait and watch kind of a period. There is no need at this point to respond to the lower inflation, because as you said, the inflation, it is not structural, just a one-time cut. Also, we spent some time on this, what happens to prices, whether the GST cut goes to the consumer's pocket or some of it goes to the producer's pocket. And your view is that it will be somewhere in middle. In competitive spaces, we should expect most of the pricing to go to the consumer, and a lot of the cut actually is in very competitive spaces, so that should go to the consumer. There will be spaces where it doesn't fully transmit, and so net, it is a big consumption boost, and it should hopefully change the trajectory of growth. And if it does change the trajectory of growth, we should see more investments, etc. come in. And if that happens, this is a virtuous cycle, so that should just help dramatically. And so putting all of this together, it's a major reform.
Yes.
Which hopefully over the next months, we will all start to see the impact of it.
Yes.
Thanks, Neelkanth, for a great conversation.
Yep. Thank you for having me.
Thank you for listening into this episode of Open Dialogue. I hope you enjoyed this as much as we've enjoyed bringing it to you. We are overwhelmed by the response that we've received and really look forward to your comments and feedback. Do like and subscribe to our channel to keep track of new episodes that are coming through. Thank you.